If you read a negative analyst report, you quickly sell off your holdings. And when the market takes a dip, panic sets in, and you sell your stocks only to buy them back again when prices seem to stabilize. At first, this feels exciting. You feel like you're actively managing your investments, staying engaged, and making moves to stay ahead of the market. The thrill of making quick decisions gives you a sense of control and involvement in your financial future. But over time, something starts to bother you. Your account balance isn't growing the way you had hoped. You decide to take a closer look and realize that constant buying and selling have racked up significant transaction fees and taxes. Every time you make a trade, there are costs involved that slowly chip away at your returns. Even more frustrating, you find that you often sell in a panic when the market dips and buy back in at higher prices when things start to stabilize. Instead of following the basic buy low, sell high strategy, you're inadvertently doing the opposite. By the end of the year, your returns are much lower than they would have been if you had simply held on to your investments. And it's not just your financial balance that's affected. The constant stress of monitoring your portfolio, making quick decisions, and reacting to every market movement has taken a toll on you emotionally. You find yourself worrying about your investments all the time, losing sleep over every market dip, and second-guessing every decision you make. You realize that your approach, far from being effective, has actually been counterproductive. The excitement you felt initially has turned into frustration and exhaustion, and you're left wondering if there's a better way to manage your investments. Instead of overtrading, the smarter approach is to stay informed about market trends and economic factors, but learn to filter out the noise. Not every headline or market movement requires a reaction. Trying to time the market or making frequent, quick adjustments usually leads to mistakes that cost you money in the long run. Think of investing like sailing a boat. You need to keep an eye on the weather and adjust your sails as needed. But if you're constantly changing direction with every gust of wind, you'll never make it to your destination. The key is to maintain a steady course, making adjustments only when necessary based on significant long-term changes.